The Fall Classic is going on? No, not the playoffs in the World Series. October 15th deadline is behind us. This is the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the partner in charge of accounting and auditing at Sobel. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/now to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of the NJCPA or Sobel. Okay, we got two big items I wanted to talk about today. First, the FASB came out with ASU 2022-04, Liabilities-Suppliers Financing Programs. Now, I talked about this topic probably months ago. Go back and look at other episodes. Maybe you can get nano credit for that. And I brought it up when we were discussing it as exposure draft, and I know what most people did. You just went, forget about it, I'm not even going to listen. Well, it came out. They seem to kind of push this out pretty quick. It's also referred to as reverse financing, payable financing, or structured payable arrangements. What? It allows the buyer to offer its suppliers the option to access payment in advance to third-party financing providers, which the buyer has confirmed is valid. What? So what they're saying is that you as a buyer can prepay for materials for your supplier. That's what this is all referring to, and you're in essence financing your payables in advance. So what's going on with this is going to require, and most people say, let me step back real quick, most people say, well, isn't that just a deposit or isn't that something else? Well, it depends on how it's structured. If you're just putting a deposit down for materials, that's one thing. But if you have an arrangement with somebody where you're actually financing it, and this could be that you're not just prepaying, you're getting the materials or you're paying the materials even before they have the materials. That's where this all comes in. If you look at this whole chain of activity that's going on, very simple. I'm going to buy something and you want a $20,000 deposit, that's easy. But if you start saying, okay, now we need to get this material, but you need to get material and they need to get material, and you have to go down the line, there might be some structured arrangement. That's what this relates to. And I'll talk a little bit more why this is coming up and why it's coming out so quick. The big thing is it's going to require annual reporting for a buyer in a supplier financing program to disclose at a minimum the following qualitative and quantitative information: the key terms of the program, description of the payment in terms of the assets pledged, okay? And for the obligations where the buyer has confirmed and it's valid, the amounts outstanding, the descriptions of those obligations, and roll forwards of obligations. That's at the annual. In the interim, you at least have to continue to disclose the roll forward of the obligations too. It's effective for fiscal years beginning after December 15, 2022. So why am I so into this? Because it's 2022. This goes into effect for calendar years, January 1, 23. Just a couple months away. So you have to start looking at this and start talking with your company or your clients if they're going to have these arrangements with any of their suppliers. Why do I think this is a big thing? Watch any of the news broadcasts. They're starting to talk about certain possible recessions coming up. The economy's taking an enormous hit. You could have suppliers that start saying, okay, I'm having difficulty paying for materials and I need to start financing in different ways. So you need to start watching and talking within your company or talking with your clients about this. It could be something that could pop up. Okay, let's move to the AICPA. SAS 145, understanding the entity, its environment, and assessing the risk of material misstatement. It provides the guidance and revised definitions that enables auditors to improve the risk assessment process and their own audit quality. Now, if you remember a couple episodes back, I also talked about the quality management standards that came out. It's effective for financial statements for periods ending on or after December 15, 2023. Now, I hate saying those dates because, again, like an exposure draft, everybody just went, brrr. I just got through tax season, tax filing deadline. I just got through EBP filing deadline. I got school deadlines that are hitting me. I'm not thinking about years ending after December 15th, 2023. Well, what really concerns me, and the big reason why I bring this up, is we're getting close to planning our engagements for calendar year end. And the common peer review issues that I see relate very much to risk assessment. Now, we're still under the old risk assessment standards. You can look up SAS 145 and see how that helps you understand the old risk assessment standards, because one of the things that the SAS 145 actually brings up and talks about is inherent risk. You go look back at the old risk assessment suite, I think it was 104 through 110, never talked about inherent risk. And I don't know why it's such a key element, and I'll talk about deficiencies in peer reviews that I see. They finally put it into 145. I was really happy about that. But the common peer review deficiencies that I see on a regular basis, and Frank, who talks with me all the time, he sees on a regular basis as it relates to risk assessment, are improper documentation for the control environment. Now, we always used to call it internal controls. If you notice, the name of the 145 is, and I'll just read the beginning, understanding the entity and its environment. Okay, it's not just the control environment; it's the whole environment. It's the control environment, not just internal controls. Okay, so properly documenting the understanding the control environment, especially IT, is the AICPA wants you to focus on. Another issue is walkthroughs. Walkthroughs are notoriously weak when we look at work papers. What most auditors do is they write a real fun story. So-and-so goes to the bank and makes a deposit, and so then comes in and makes the coffee. And they really write a really nice story. It's a fun narrative to read, but it doesn't focus on the key controls. Your walkthroughs are supposed to focus on the key controls within the environment. Identifying and assessing inherent risk. Now, whatever practice aids you use, go back to them and look up the different components of inherent risk. I know the ones that we use. I'm not here to mention different names because I don't want people to think we're trying to sell software or we're advocating for any practice aids. But the one that we use has around 9 or 10 different levels of items that can come in and be considered for inherent risk, including audit difficulty, the number of transactions, the complexity of the area just in general, the difficulties you had in prior audits, the competency of the people working in the area. So there's a lot of different things that you can consider. But look at your practice aids, because I know our practice aids has a specific checklist that lists all of them. And if you can't find it, reach out to me and I'll let you know. The other item is the control risk assessment. Most people do and probably should assess at maximum. Okay, if you're not going to be testing controls, then it should be assessed at maximum. And the big item, the one thing that the AICPA always focuses on and we always look at, is how do you connect the audit work that was done with the risk that was assessed? And this is very difficult because I know that most software providers and most practice aids don't have a very good connection. On a peer review I did with a particular firm, it was the best. The risk assessment was right in the particular audit area, and you could see the connection from the work that they were doing to the risk assessment. Most of the firms that I look at, including our own, the risk assessment's up top and the audit work is all down below, and you don't see the connection. And we've made a very concerted effort to try and make the connection to at least from the risk assessment to our audit program. So if you take one thing out of this, the connection, the closing the loop between the risk assessment and the actual audit work performed is the key area. And of course, update the risk assessment if necessary. So that's the big area. I want to make sure we talked about peer review, and not peer review itself, but this upcoming year and what you should consider. All right, in closing, I'd like to let you know about some upcoming virtual NJCPA events. Break down the new Auditor's Reporting Suite of standards for non-ERISA engagements on November 1st. Disclosures, the key to financial statements on November 2nd. And an annual update and practice issues for preparations, compilations, and review engagements on November 8th. Register for these events and more at njcpa.org/events, and be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.